to provide a bit of feedback to both our users and also hopefully ESMA down the line on ESMA's proposed regulation of the European Forex and CFD market. And today we'll try and do a bit of a detour to explain to you what goes on, because there's quite a lot of misunderstanding as to why, how many people lose, why they lose, and essentially the chain of events that ends up with too many people losing money that they shouldn't be losing. We will then review ESMA's proposal, which unfortunately is pretty flawed. I mean, it has the right intentions, but it goes about it backwards, as we'll explain. And we have a counter offer, which we will convey to ESMA, and we'll also share with our user base in case any of you guys agree with it, to simplify the process of providing feedback. Because as you will see, this does affect you, and we might as well try and do our best to help ESMA come up with the right solution to the mess. As with anything in life, there are two sides to this coin, and I will first go through the demand and supply side of things after we have gone through ESMA's proposal, so you know what goes on. Okay, so can you guys confirm that you can see my web browser? Doesn't always work. They should. So we should be seeing Chrome browser site with ESMA's consults on potential CFD and binary options measures and so on. Okay, so basically when it comes to, I will not even talk about binary options. I think that's a foregone conclusion. That's a gambling product and it should be regulated as such. So that's kind of not the subject of today. Today we're going to talk about the contracts for difference, CFDs and Forex. And the 5 measures that they're contemplating are essentially to impose a pretty drastic reduction in maximum leverage vis-a-vis what's typically offered in the market today, from say a maximum of 30-to-1 leverage in pairs like the euro dollar to 5-to-1 on the most exotic pairs or even the single stock CFDs. There's also a reasonably technical rule on margin closeout, which, by the way, neither MT4 nor MT5 can cope with at the moment. So let's see how that ends up. There's a negative balance protection on a per account basis, which doesn't really make any sense, as we'll explain. And then last but not least, they want to impose restrictions on incentivizing of trading, such as bonuses for introduction and so on. And of course, a standardized risk warning by CFD providers, which will hopefully be more useful than every standardized risk warning provided in the market to date, because they don't seem to be working. Okay, so let's do a bit more of that. All right, so those are the measures, and today I would like to give you some insight as to how we view them. Our view, unfortunately, is not a very strong one, in the sense that I suspect by the attention we get from our liquidity providers, Darwinex is one of the very, very few true brokers out there that routes every single trade from customers directly onto the market without ever taking any risk in customer positions. Okay. Now, unfortunately, because we have chosen not to trade against customers, we make less money than so-called broker dealers who internalize the losses, as we'll explain in a bit, and therefore we don't have an advertising budget to make our voice heard. So what we've got is 3,000 happy users, many of whom are winning, that we hope to leverage to inform ESMA that there's room for self-improvement in the CFD market, and that's my agenda today. I'll be fully transparent with that. By the way, we stand to make nothing if ESMA goes through with our proposals. What we want to do is just have a level playing field to compete with dealers. Okay, so those are the rules, and this is our interpretation of those. Now, let's start with the demand side, the poor trader out there. Now, here we've got a virgin, innocent retail trader who lacks training, who therefore also just started and lacks capital, and also lacks a viable business model, because as we've argued elsewhere at Darwinex, you can't really consistently make money, like serious money, without taking a lot of risk if you start from too small capital. Okay, so here's a poor victim. And here is what happens. So whatever he or she lacks in training and capital, he's got greed to spare. And then all of a sudden you watch some football, as typical people do, and you see oh, some advertising for a listed broker. Now, a lot of people demonize broker dealers. I hope my message today is not taking as being against broker dealers in any way. Moreover, I will be using data from IG Markets, which is a company I hugely respect. They are very transparent in what they do, and I don't think they have any bad behavior towards customers. And also Plus 500, which is lower on my respect table, but nevertheless is carrying out a legally regulated activity, and as such deserves at least the benefit of the doubt. Okay, so you are some guy who maybe feels a bit attracted to trading. You go watch some football match and you go, what is this Plus 500 thing? And then you see, oh, this is kind of interesting. I can get rich quick. Okay, so you fall into this dream, which has, well, fudged generations of retail traders before you. And then sooner or later, reality sinks in and you start saying that it's not always up, it can also go down. And quite often, if you lack the training and to understand what's going on, this is the outcome, and it's not nice. I mean, it is true that most people who trade with leverage end up losing on the demand side. Okay, so ESMA is really trying to tackle a real problem, and we fully support that this be tackled. So the important thing, though, is to understand why this happens. And I'm not going to go into lots of detail about this one today. There is plenty that has been written better by smarter guys than myself. I'll just give you the core references, which won, by the way, a Nobel Prize for economics. The subject is called loss aversion. And you can think of it in financial markets equivalent to Newton's law of gravity. The two guys that came up with it were two geniuses from Israel, Mr. Daniel Kahneman and Amos Tversky. There's a very, very nice book called by Michael Lewis on, I think I've forgotten the name. But if you check out, so Michael Lewis and Tversky, which is a meaningful enough word, you'll be able to find it. I really highly encourage you to read that book. It's very readable, as everything that Michael Lewis writes, and it explains, amongst many findings, this one they did, which is that the human mind derives more suffering from a $100 loss than it derives pleasure from a $100 win, as you can see in the shape of this curve. And as a result of that, this is basically the justification for the trader adage of cutting your winners short and letting your losers run. That's what this bias does. And very importantly, the more skin you've got in the game, in other words, the more leverage you are, the sooner or the more likelier you are to behave irrationally as per this systematic bias that you've got. So in a nutshell, what loss aversion implies is that if you take an untrained guy, like we've got here, who starts off with tons of leverage powered by greed, he's far more likely to cut his winners than he is to cut his losers. And as a result, he will be worse than a random monkey. A random monkey would be winning half the time, leaving aside transaction costs and spread, whereas a loss-averse superior monkey is bound to lose systematically. Okay, and this is the root cause of losses. I haven't really explored this in detail, but the French regulatory authority did some research, and what they found was that, and here's a question for you guys. So what percentage of the losses by losing retail traders goes in transaction costs and the spread? How much would you guys guess it is? Numbers? Come on, guys, give it a shot. 10%. Okay, so Jan knows about this one. It's actually a bit more than that, but they found it's 15%. So for every £100 lost by a retail newbie, 15 goes in transaction costs, which is what a monkey would lose, a random monkey, and 85 goes into in this category, the loss aversion category that we just discussed, the systematic bias that fools us into losing systematically. Okay, so this is the problem, and unfortunately, short of education and trading without stress, there's nothing that can really fix it as long for as long as we can't modify brains. Okay, so it's kind of a given. So the vicious circle we've got, just to summarize, is ignorance, which breeds greed, which entices you to take more risk than you're prepared to handle, both financially and emotionally. That triggers your biases, and you end up losing. And then you're dead, by which point that you have fed the churn machine, which then sponsors F1 and football and so on to get another sucker in the door. Okay, that's kind of okay. So let's go for the supply side, and I think you'll see some pretty interesting numbers. I mean, over the years, I've been forced to look at the public numbers by listed broker dealers, and I think it's actually quite interesting. So I hope you'll enjoy what comes next. But because of course, when we have a demand side which is losing systematically on account of the reasons that I've mentioned here, you've got a supply side which has a certain set of incentives. If you see people who are losing systematically, your incentive then is to try and internalize those losses for systematic profit. And then the whole thing becomes an acquisition arms race to see who can get suckers in the door faster, more cheaply, which is the whole issue in that I think ESMA is trying to event. Now, as I said, I'm not against those guys, because we're talking about, I mean, we're called Darwinex, and the Darwinian is a good summary of capitalism. So if any of you guys was watching at a cliff and you see all these people just jumping off it, what opportunity do you guys see? I mean, it's pretty tempting, right? Okay, well, you basically say there's got to be a ton of lambs down that cliff. I can probably get a butcher shop and get my raw input for free. That's what I would think, at least. So, in this case, you've got every incentive to eat meat as opposed to vegetables. I'm trying to do an analogy here where I think of systematic internalizers or market makers as people who prefer meat. And I think of brokers like Darwinex as vegetarians, in the sense that, yes, we make some money off the sheep, but we'd rather fleece them than skin them, right? So I'm not trying to say that we're whiter than white. We do have to make money, and the technology that you use from us consumes a lot of developers, and we need to pay for them. So we have to make money out of this. It's just how you make it. You can choose to make it from your customers or with your customers, and we've opted for the vegetarian side of things. Okay. So let's see some numbers, and also some words which are actually quite interesting. So this I've gathered this information from an investor report that is in the annual report by the CEO of a publicly listed broker dealer, which is IG Markets, whom I highly respect, by the way. This is not anything that I have against them. But what you see here is the revenue they make from 3 alternative potential business models. The first business model, as we see here, is the curve on the bottom, is the revenue that IG would have made if they had fully hedged all customer trades. Okay. If instead of choosing to internalize any of the customer's systematic losses, they had stuck just with the 10, 15, 20% of commissions that they pay you as they trade. That's one extreme that I call vegetables. The other option, which they don't do, by the way, is to become a betting house where you systematically take the other side of customers' customers' losses. So not only do you pocket the 15% of commission or transaction cost that we've mentioned before, you also internalize the systematic losses, because let's not forget, no one forced these guys to jump off the cliff. Okay, so all you're doing is realizing people are jumping off the cliff and saying, well, I've got shareholders, I've raised capital, I have to maximize the return on my capital. And internalization, which is not trading against any individual customer, it's simply basically internalizing the spread and unfortunately letting customers sort of commit suicide by themselves, is not something which is wrong. Now, of course, that is also risky, because if you systematically trade, take the other side of customers' losses and never hedge it with anyone else, there are times when customers really go all out one way or the other. And when that happens, they might actually be winning. So here you see a spike where customers lost a lot of money, and this peak at 60. But then, of course, you would have had also a pretty big drop when customers pile a certain way and make money from you. So it's a risky proposition. And what they do is optimize their risk return on their shareholders' capital by very legitimately choosing only to hedge once they reach a certain risk threshold, as you can see here. And they engage in that so-called broker-dealer model, which is a hybrid between both models. In practice, in the retail CFD world, there's hardly any vegetable eaters, like Darwinex is a very rare example. But there's also very, very few full meat eaters. In practice, most of them tend to be hybrids, although if I had to say, they eat more meat than they eat the vegetables. Okay. Any questions so far, or any things that anyone disagrees so far? This one is a pretty important one to understand, and it's not immediately obvious. So if I fail to explain anything here properly, go ahead. I mean, as I said, vegetables is an analogy for a broker, which is the lower revenue. Meat is a full stack market maker, full stack B-book, which internalizes all the other side of customers' P&L and therefore presumably losses. And the middle one is the hybrid, which is what most are in practice. Okay, so now, unfortunately, if you don't do anything to stop the lemmings from jumping, then they do jump and you have atrocious client attrition. So these are cohorts tracking out of the total amount of people who start trading at any point in time, at point 0 in time, how many of them are left after 1 month of trading, 2 months of trading, 3 months of trading, and so on and so forth. And you see that so half of them are gone in 5 months-ish, and it sort of plateaus down at a level of like 35% of people who continue trading after that. But you've basically lost 2/3 of your user base by the first year since you acquired them. So you need to make up for that, because otherwise, there's no business, right? You need fresh blood. So unfortunately, the trouble with this is that if you choose to internalize, then you have more juice, more margin to beat farmers at acquiring new customers. So if I choose to, unfortunately, this is a typo from the Spanish version, if I choose to internalize the losses, then I have a higher budget of revenues per customer than I can then use to acquire new customers. So in the short term, meat, so winning from customers instead of with them, beats hands down the broker farmers, if you see what I'm trying to get at. So this jargon is what plus 500, the two most important numbers, if you look at plus 500 investor reports, are this ARPU and AUAC, which are conveniently disguised because ARPU means average revenue per user, and AUAC is average user acquisition cost, which is another way of saying I spend, in this particular first half of 2018, they spent on average $836 to get a new customer to place a first trade, and they made about twice that from said customer, which is essentially the profit margin, and that you make from internalizing until the trader churns. Of course, and this is the important bit, if they couldn't internalize, and this is the core feedback that we can give to ESMA, if they couldn't internalize, then they wouldn't be making all this money, and therefore they wouldn't be investing all this much in advertising, and therefore not so many people would be trading with them. But then, of course, it's legal, so why wouldn't they? Okay, so that's kind of the core issue here, and the causality is, as I said, because they eat meat, they have very little incentive to teach the guys not to jump off the cliff, because they're making far more from the dead sheep than they are making from the wool. So they can afford to advertise far more than, say, Darwinex, which, by the way, doesn't advertise, not because we don't want to, it's because we can't. We just don't make the money back if we advertise. Okay. And then here we go. You put all that together. I mean, if you look at, there's a couple of things I haven't really said, but I look at the scale of this thing is, this particular broker had 25,000 first trades in the first half of 30,000 the first half of 17, and 27,000 the second half. You put 2 and 2 together, it's 57,000 new people at about £1,000 per new guy. That's 60 million. I repeat, 60 million invested in acquiring fresh blood into the game. In this particular case, I think you do the numbers again. It's 110,000 roughly new customers. If you put the first two halves, well, I can't see the second half of 2016, but 100,000 new customers at about $1,000 a pop, because you see that this was higher. We're talking about 100 million investment into advertising, and which is what you see here, including affiliates, of course, and so-called trading educators. And then here we go. We're back to square one. That's where the whole game started, right? So this is we're full circle in the food chain here. That's how it all works. Okay. So now that's what ESMA said is sort of trying to, well, that's what they see. They see some sort of evil hunter that's killing the baby seagulls. That's actually not what goes on. What happens is more like there are a bunch of lemmings who are jumping off a cliff, and no one really has an incentive to tell them not to jump off the cliff because, hey, you know, they taste pretty sweet once they're down the cliff, right? That's kind of what goes on. It's not like the evil hunter is killing them. It's actually they're just sort of feeding on the carcasses as they have committed suicide themselves. That's kind of the more suitable analogy. And I'm not trying to make a moral judgment here of the good guys or the bad guys. It's actually the market. You know, if it's possible to do it and it's profitable, then you can count on somebody trying to make money off the back of it. So it is going to happen. You can't change it. More importantly, you can't change the human brain without education. So you can overcome the biases that we've talked about with education, but unfortunately, this is not an education arms race. It's an acquisition arms race for the reasons that we discussed. Now, it is impossible, and this is to some extent, as we'll explain later, what ESMA is trying to do, it goes against the very nature of capitalism, and therefore it's not only unnecessary, it's also bound to fail. It's not going to work. But we totally think that ESMA has to do something. Okay. Now it's just that not that's something that they've offered to do. So in the light of what I've just discussed, let me go through what I think in terms of the proposals here, and trying to act as devil's advocate here. So leverage limits on the opening of a position by a retail client. So note this retail client, which is sort of demoting all of you guys to basically subhuman, retarded beings who are incapable of thinking for themselves just by virtue of not working for a financial institution, which is something that really makes me mad. Okay. Now, yes, it's true that a lot of people are, I would say a majority of people are losing money on account of taking on leverage. But hey, if 80% of people are losing, that means 20% of retail guys are winning. So who is ESMA to not allow you to take on leverage if you know how to handle it? I mean, I think that's a pretty important question that they should be asking because, of course, yes, you're trying to protect the 80%, but then you are severely jeopardizing the 20%, many of whom actually maybe need that leverage to make a living. More importantly, they're talking about the real issue is risk, and leverage is a proxy for risk, but it's not a perfect proxy for risk, right? So if you're a scalper and your strategy works really by doing volume, and these guys come in and don't let you do any more than 5-1 because you trade some exotic currency, then you're dead. Your strategy is gone. Even if it was a winning strategy, somebody has come in, it's protecting you from making a livelihood by imposing this draconian leverage rule on you, even though it doesn't really mean a problem for you. Actually, it's the only way for you to make money from this. The margin closeout rule, I mean, I'm still waiting on that. That's a pretty technical one, but the proposition they've made, MT4 cannot handle, and we'll see if MT5 can handle it. So I don't know what they're thinking here. Now, the negative balance protection, that's one in and of itself. And probably don't get me going on this one, but what this is saying is basically, okay, so if you take on leverage and it goes your way, then congrats. If it goes against you, well, then congrats too, because you're not going to eat the losses, somebody else will. So it's a free option that ESMA is graciously gifting you. It's a bit like saying, okay, here's full insurance cover on your car, and there's no, what do you call it? there's no franchise. Okay, so you get full insurance. We cover every damage in your car, doesn't matter how small. So much so that just go ahead, be my guest, and scratch it as much as you want, because I'll take care of it, no problem. Then there's a restriction on the incentivization of trading provided by a CFD provider. That one, probably makes sense. I mean, this appeals to another bias, whereby if you're offered something for free, even if it's shit, you will ask for it. So all these bonuses trigger something in your brain which makes you want to have it because it seems free, and then you get hooked up, and then you're doomed. So probably, this one is about the only one that I think makes sense. And then 5, a standardized risk warning by CFD providers, because all the standardized warnings that are already out there, they're not good enough. They're working, we need to do something about the standardized risk warning. So there you go. So in a nutshell, you've basically got something which has a lot of collateral damage, a rule which I don't really know what they're trying to attempt here. We'll get back to this once we've seen the final proposal. The negative balance protection, which goes against the leverage limit. So on the one hand, limiting your leverage, which is chapter 1, and then chapter 3 is they're encouraging you to take as much leverage as you can, which is, defies my logic, if you ask me. And a couple of ones which are really tackling the symptoms and not the root causes. If people make money by incentivizing the trading, they will find a way to incentivize it that overcomes the rules. The issue is, where does the money to incentivize come from in the first place? That's what you should be tackling. Okay. So yeah, unfortunately, not much that we can salvage from ESMA's proposal, and not much that it's going to accomplish, which is the tragedy in the whole thing. So it tackles the symptoms instead of the root cause. And then it is going to introduce a lot of collateral damage, because, many of our best customers use that leverage for a living. I've sort of discussed this beforehand, but as I said, here are the questions for ESMA. So if I'm a suitably informed retail trader, why can't I use leverage? Why does Big Daddy have to tell me what I should be doing? Maybe I just do this for fun, and if I take the leverage out, the fun's gone too. I totally understand that they have a right to intervene, but that's that's where we should be starting from, right? Like we should be starting from a position where people are grown-ups and understand the risks involved, and if they don't, it's better to invest in education than in prohibitions. Now, if I'm a winning retail trader, as I mentioned, why can't I borrow? So imagine a guy who does a living in buying and selling real estate and flipping properties, and he does that very well. So surely that guy should be allowed to borrow to do that faster. You may or may not like it, but it's called capitalism, and we've all agreed that it's for lack of a better one, it's the best system out there. So are we going to impose a subsection of the market, which is the CFD market, that works with rules different from everything else in the economy? More importantly, this goes straight to the point of negative balance protection. So imagine you were somebody who wasn't trading with leverage, with, say, FXCM, which is now bust, or Alpari UK, which was also bust, at a time when everybody else is leveraged to the bones and the Swiss franc goes very badly against other customers. And you've made some money from the market because you were right on the right side of the trade, but because those guys have gone bust with leverage, and graciously ESMA has agreed that the liquidator cannot go after the debts, which is essentially your profits that you should be collecting, then you're basically left out without a broker, without your profits, and very likely without the money you had in the account, just because ESMA didn't get the causality right. So the negative balance protection is just insane. And last but not least, if you're a retail broker like Darwinex that has basically invested a lot of money in getting a proposition working whereby people traders, they have fun and make money as they do it. So who's ESMA to say we can't advertise? Not that we're not really advertising. We believe in word of mouth, but if we wanted to advertise, what are we doing wrong? If customers are winning, why can't I advertise? What's wrong with it? Surely if somebody doesn't know about a place where you can make money, that place that makes money should be able to let me know that there's a way to make money at that place, because surely it's a win-win for me and for that place, right? So who's ESMA to say you can't do it? So, I mean, I think they are well-meaning, but they've got it completely backwards. And there's a saying in Spanish, you can't put a door out in a field, because if you put a door out in a field, well, then this is what happens, right? So, you can do whatever you want, but people are totally going to bypass it. And all that's going to happen is you're going to be wasting time and money in putting a door in the middle of a field. So here's our alternative proposal. This is what we think they should be doing, which is at root is tackle the root cause and not mess with the symptoms, right? And of course, once you've tackled the root cause, then the domino takes care of all the rest. So you just need one rule, not five. So the issue at heart here is incentives. So if we think of the demand side, I mean, the cycle was, okay, ignorance, greed, which leads to leverage, which triggers loss aversion, which yields systematic losses. Now, on the supply side, you've got two hybrid models. You've got the dealer model that wins from customers. So whatever money they're making comes out of customers' pockets. Because they're internalizing systematic customer losses, and therefore they are competing in an arms race. They have to compete in an arms race, because if they don't do that, then they're out of business. They have to invest in customer acquisition. That's the prevailing model today because it is allowed. Now, there are a few brokers out there that have a business model which is anchored on trying to win with customers. Doesn't mean they win or they lose, but at least they try, because if you eat the sheep, you can't fleece it, right? So that game is all about retention, and the focus there is investing in retention. So that's why Darwinex bends over backwards in investing in technology and doing webinars like these instead of spending the money in advertising. So it's a completely different incentive set facing the same core root, which is human greed and ignorance. Okay, so it's two completely different business models, and unfortunately, one of them has the upper side in the short term, as we've seen on the dealing side. So in our view, what ESMA should be doing would be to discourage internalization, so make it harder to make systematic profits from systematic losers, and by virtue encouraging retention. So they need to try and impose rules whereby these two lines get closer to each other, which means at some point newbies will be learning that there are also brokers in addition to dealers out there, and that dealers are not always the best option for them, so that they can make up their choices and by informing themselves as to what a broker and a dealer is. They should be hearing both sides of this story. And here's the proposal. Okay, so what we suggest is for ESMA to socialize systematic losses on MiFID multilateral trading facilities, which are literally exchanges. Okay, and here's the reason. So what we're saying is force CFDs to trade on an exchange. Because if you force everybody on a single order book, then everybody is allowed to both take liquidity, which is what they do today. So they can be the gamblers taking prices from the house, but they can also be the providers of liquidity, which is another way of saying playing like the house. This is what Betfair did with substantial success at the beginning of the century. And this is, by the way, if all things go to plan, what Darwinex will end up being in 5 years' time. Why is that? Well, because if there are any systematic losses, which you cannot prevent, because as we've discussed, there's ignorance, greed, and you can't really stop that in the short term, at least what you can do is make sure that all those lemmings that are jumping off the cliff are not eaten exclusively by the market maker, but the losses are socialized between all the market participants. In that way, you don't have a huge pocket that's going to advertise. You have lots of tiny pockets that are each too small to advertise to attract new systematic losers into the game. This breaks down the excess margin from the monopolistic market making. So the excess fat that you make by eating meat instead of eating vegetables is gone. Moreover, because everybody is trading against each other in a single order book, then the way to spread those systematic losses is actually to reduce the spreads for everyone and the counterparty risk, which makes sure that things like the Swiss franc are far less likely. So if everybody traded on the same venue instead of on as many venues as different market makers, then very likely either the Swiss franc situation wouldn't have happened, and if it had happened, which maybe would have because it was meddling by by the Swiss central bank, it would have been far less severe than it actually ended up being. And last but not least, because the advertising budget is gone, it has been socialized with everybody that is feeding off the carcasses of the lemmings. No one will advertise because, hey, no one is stupid enough to advertise to get suckers into a poker table if they can't rip the suckers off at the poker table. Okay, this is kind of a bit abstract in the words that I've said, but I think it should make sense after all we've gone through. So if you take away the benefits of just eating meat, then people will stop advertising to get the wrong people into trading, and the issue is gone. Okay. Now the benefits of these proposals are that the leverage winners are free to continue making money. So the biggest piece of collateral damage is gone. Furthermore, the whole industry will shift the focus from lowering the average user acquisition cost onto increasing the average user lifetime. So if we go back in the presentation, the focus should not be on getting, we'll come back here. So imagine the clever guys who who made a plus 500 at 1 billion company within, say, 5 or 6 years. Those guys, if you don't let them make their money from advertising, they will shift their brilliant minds onto, instead of lowering the average user acquisition cost, increasing the long-term revenue per user that is done not from market making against users, but from making them winners that grow their accounts and pay increasing spreads and commissions, right? So that's kind of what they should be doing. But they won't be, because as long as feeding of the lemmings is allowed, people will feed of the lemmings. Sure, you can say, okay, no more than 5 lemmings ahead or something like that, but the fact is they will still be looking out for lemmings, and because they are very clever, they will find a way to make more money in ways that are not good for the end customer. Okay, so that's what it is. I would be very, very keen to hear your thoughts on what your take is on this one. But that was essentially it. So our take is one single thing: force all retail CFD trading onto MiFID multi-ladder trading facilities. And if for whatever reasons that's too tough, which I don't think it should be, then at the very least, don't impose on farmers, which is like Darwinex, the restrictions that you're applying on butchers, because that's completely counterproductive. Okay? That's our take on ESMA. So I'd be very keen to gather your feedback on any of the points that I've made. Maybe I'm just, it's always good to hear somebody else's thinking on the subject, and see if any of what I've said is flawed. I don't think it is, because I've been thinking about it pretty hard, but I'm very keen to gather your feedback, because essentially the webinar as such is now over. We're now up to the Q&A. Okay, so this is a good point that Jan is making. So if the measure is implemented, how may this affect the Darwin? Well, luckily, we agree on the core issue that too much leverage is bad. So that's why we lowered the value at risk to 10%. And I think the most leverage a Darwin will ever take is well below 10 to 1. And we don't really offer the minor currencies, which are going to be subject to the tougher restrictions. So this doesn't affect the Darwins, but it can affect your trading account if you're a trader. Okay, you're asking on timelines here. The timelines are unknown. I mean, one thing that worries us is that ESMA hasn't really provided a lot of time to provide feedback on this, which sort of hints at the willingness to just push through with this, and with the feedback just being a rubber stamping exercise. But what I've heard is the earliest I've heard is the 1st of April, and ranging all the way to beginning of July. So either beginning of Q2 or beginning of Q3. But as I said, it's not even final that the measures will be taken. And for sure, out of all the measures that are here, the closeout, as they have specified, is quite a systems challenge that brokers will need quite a bit of time to adjust. So I'm not sure what the road is from here, but I am worried that the thinking doesn't seem to be tight. I mean, to me, what looks, I mean, the regulators are very capable people, so I don't think there's an issue with not understanding what's going on. I think it's more of an issue of the difficulties in coordinating regulators from a lot of different jurisdictions. That's what I think the challenge has been, because this looks like, I mean, there's no point doing a rule where you say point one is this, and then point three undercuts half of the benefit of point one. Okay, it looks like you guys are on board. By the way, I mean, we were, as anyone following us, we were, as it was, going to offer futures and single stocks. I am very, very happy to report that we now have beta testers live trading futures in Darwinex accounts. So the clock is already ticking to releasing futures for everyone's benefit, as well as single stock DMA CFDs, where you don't really need all that much leverage to make good money anyways. So yes, Eric is saying these restrictions affect retail traders. A solution would be for people to go professional, and yes, that's one way to bypass the regulation. But that's kind of going back to the point we made here, right? So that's another way of basically saying that this is just pointless because people will bypass it. That's we're looking at essentially this one, right? If people are going to bypass it, why set it in place in the first place? All right. Okay, sounds like we're good to go. It's been a real pleasure to be with you guys here today. We will have our next webinar with a couple of accomplished algorithmic traders teaching us how to start thinking about setting up a algorithmic strategy in the next webinar, and that will actually set a trend. So going forward, we would like not us to be pitching on all these, but rather for our own users to be educating the rest of our users, because hey, I'm not a trader myself, so who am I to teach you guys about stuff? We do, having said that, have a bunch of traders on staff, and some of them are pretty good. So maybe we could use some of our employees to give some presentations. Okay, sounds like we're good. Thank you guys for your time. It's been a real pleasure. As I said, this will be uploaded into YouTube. So if there's anything that remained unclear or you joined late in the presentation, you will be able to watch it from pretty much later this evening in our YouTube channel. So thank you so much. Take care, and I really wish you very good trading. As I said, the fact that a lot of people lose is the very reason why you can make a lot of money. So I encourage you to not be ignorant and go for it. Okay. Take care. Best wishes. Bye.